I like that. I like that painting. Is that you?
Yeah, that was a gift from my girlfriend from last
No, I love that one too, bro. Yeah, yep.
Very
That's
nice.
great.
Very nice.
I'm royalty.
Very nice.
I have question.
What's up, Ellie?
What's up? What's up?
How you doing, man?
When it comes to the mortgages, I know the rates, they supposed to go up. Everybody's freaking about it, right?
Yeah.
Do you think besides the rates, do you think also the regulations and qualifications going to be getting tighter again?
It's a good question. I don't see that happening because over the past year and a half, when COVID kicked in, everyone stepped in, like Fannie Mae, Freddie Mac, who are the governing bodies essentially for conventional loan guidelines, hit us with a bunch of what are called overlays, or well, basically, it's just like additional guidelines, basically. And they reversed quite a lot of them, but a lot of them stayed as well. And a lot of them aren't going away anytime soon. There's no talks of them, so they're staying. FHA as well did a few. They also did a really, really nice guideline change. I don't know if you guys heard, but they made a change to the student loan calculation back in August, where we only have to hit them for 0.5% of what they owe on the student loan, as opposed to a full 1%, right? So basically, if someone has a $100,000 student loan, and then we have to hit them for 1%, so $1,000. Instead of hitting them with $1,000 a month, we only have to hit them for 500, which is good because it's improved people's ability to qualify for FHA, because it was a very, very big issue before, especially with the most common population that I experienced this issue with was with nurses and people in the medical field in general. Got a lot of nurses and people in medicine who take FHA loans and pull money out of their 401k retirement for that 3.5% down payment. So that has now enabled a lot of them to get qualified. So that's a big one. But to answer your question, John, I don't see the regulations getting any crazier. I would be really, really shocked if they did. But even conventional loans, they didn't necessarily change the guidelines. I mean, they did. I mentioned that. They did change them. But what they also did, are you guys familiar with automated underwriting systems? Desktop underwriter, which is known as DU, or loan prospector, which is known as LP. Does any of that sound familiar?
Guys?
Yeah, I mean, I think I heard Peter talking about it once.
Okay, so what it basically is, anytime that we have to submit a loan into underwriting, we have to run it through the AUS, the automated underwriting system, which basically says the file is good to go or it's not good to go. So for instance, like 2 years ago, you could get on a conventional loan, minimum down payment, credit in the 600s with maximum debt to income ratio, 49.9, 49.9 max debt to income ratio, that would pass the automated underwriting system. When COVID kicked in, Fannie Mae and Freddie Mac changed the algorithm for that, for the automated underwriting system, and now those do not get passed. So, for instance, someone that was qualifying with that scenario with a maxed out ratio, they wouldn't be able to do a 49. They wouldn't even be able to do a 44. They'd probably have to do a 35% debt to income ratio, or even a 39% potentially. So 35 or 39. So it's not that necessarily just that the guidelines have changed. It's become more challenging to get people approved for conventional financing with maxed out debt to income, loan to value, which basically means minimal down payment. So that's become more of a challenge too. But to be candid, that kicked in like a year ago. So we're already used to it. It's only an issue if you get a pre-approval from a loan officer that does not run automated underwriting findings on a pre-approval. So every time we pre-approve a file, obviously we run the automated underwriting findings to make sure that the file is good. A lot of loan officers do not do that. So you may end up with a pre-approval that ends up going into contract and doesn't even pass the basic system, which candidly, it only takes like 2 minutes. It takes 2 minutes to like set it up and then another 20 seconds to click the button and get an answer. It's not a long drawn out process. It's very easy. The only reason why a loan officer wouldn't do it is for 2 reasons. One, they're lazy. And 2, they don't know how to, / their company doesn't really allow them to run underwriting findings, which I have heard of before. It's very strange and quite common, unfortunately. So what could you do as an agent Simply, if you get a pre-approval from a loan officer, and I imagine that when you guys get a pre-approval from someone, you talk to the LO, you talk to them about the client, the finances, etc. All you basically want to do is ask them, hey, do you have, of course, all documentation, income, assets, credit, etc. And did you run automated underwriting findings on this client? And if they said yes, then you're good. If they said no, then that is not good. It doesn't mean that the file won't qualify, but it means that you're taking kind of a risk there.
What is the step up from the automated underwriter?
The step up is really a commitment. And here's the thing about the automated findings. I'm just going to call it AUS for short, because by now I've said automated underwriting 50 times. You know what I'm referring to. So AUS, anyone can put anything they want into the system to get the findings that they want. So for instance, if we have a client that makes 100 grand a year, but the client doesn't qualify, I can just put into the file that the client makes 200 grand a year to get it to qualify. So it's very easy to fake that stuff. And obviously it's unethical to do so. I don't know if it's illegal, but it's definitely unethical. You can fake it. A good ethical loan officer will not fake it and give you the real one and make sure that the file passes, because if they give you a fake AUS approval and then it goes into actual underwriting, because remember, the actual underwriter themselves, they run it. We're able to run it, but they run it, the way they run it is the way it goes at the end of the day. So there's no benefit in faking it, honestly. It's just kind of silly.
Unless you sort of like try to project something, right? And you probably see that a lot of loan officers, they kind of like, okay, we got to show this much income and this is where you got to be at, right? To make the file work, right?
Exactly, yeah. But maybe they're trying to get the offer accepted and the listing agent wants to see the findings. Maybe there's like a credit issue that they're working on. So they know that the file will get approved eventually, but it might take a few weeks to clean up the credit and they don't want to kill the deal. Guys do that all the time, or gals as well, I should say. At the end of the day, as long as the file closes and everyone is aware of what the plan is, then it's okay, because you can do that. You can have a file that doesn't work currently, but will work in literally 2-3 weeks when you re-pull the credit report. It's possible, but as I said, it's all in the communication. As long as everyone is on board and knows the risk, what's going on, then the transaction will continue to be smooth regardless of that outcome. At least that's my opinion.
Okay.
That's great. You guys have any questions? Alex, I know you're the newest guy on the block, so maybe this is too heavy for you, but bear with us. What questions do you
have? I mean, I'm at the point that I don't even know what I don't know, but I mean, I think I can keep up, and if I have any questions, I'll pop in.
Gotcha.
But yeah, so far so good.
So a basic question I'll ask you, Alex, is: do you know the difference between a pre-qualification and a pre-approval?
Not really.
It's really simple, and it's important that you do know the difference. So a pre-qualification is weak. It's basically worthless, right? Because what it is, it's a client calls me, I pull their credit, they say, Ben, I make 200 grand a year, I've got 50 grand in the bank, and I say, okay, Mr. Smith, here's a pre-approval, or rather a pre-qualification. And some people give pre-approvals instead of pre-quals. I don't do pre-qualifications, period, because they're a waste of time. But the difference is a pre-approval is when we verify that information. So not only did we take it over the phone, but the client gave us documentation, their tax returns, W-2s, pay stubs, IDs, bank account, retirement statements, verification of employment if we need it. This way we can analyze the file the same way an underwriter would, and we know that the deal is good. Now, I will say this, is that a pre-approval is only as good as the loan officer that gives the pre-approval. Because you can have, there are plenty of loan officers who have zero training. They don't know how to compute income or really do anything. So they'll have the documents, but they don't know how to analyze them, and then they'll just pre-approve it anyway. But obviously, if you have to choose between the two, a pre-approval is far superior to a pre-qualification, with that little asterisk that, the pre-approval is really only as good as the loan officer that gives it. I hope that makes sense.
Yeah, it does. Thank you.
Cool.
All right, I got a question.
Bring it up.
Yeah, man. So I see that you give clear to closes and you close super quick. So why, how do you do it? You clear the close in 17 days, but for some people it takes 2 months, 3 months. What do you guys do that's different?
So thank you for asking that question. So to be, not an over promiser, we have plenty of files that take 2-3 months to close. Right, they still exist, because even if I CTC a file in 17 days, as we know in the New York market, average closing time is 45 days to, as far as 90 days, right? So sometimes it doesn't even matter. But to again answer the question, my average CTC is 17.9 days. Okay, on purchase transactions, I think it's like 21 or 22. So what we do is quite simple, is that we collect literally everything upfront, every single document known to man. So what makes it easy is that when we submit a file to underwriting, we have probably anywhere from 50% to 75% less conditions. Do you guys know what conditions are?
Yeah.
Okay. So for anyone watching that doesn't know, conditions are basically items needed for the underwriter to CTC a file. So because we submit a more complete package up front, our approvals are much, much cleaner, and they don't take a long time to fulfill and get the file clear to close. That's probably the number one reason why we get it done so quickly. The other reason is that we send the majority of our loans to one lender called United Wholesale Mortgage. United Wholesale Mortgage is the number one wholesale company in the entire world, let alone the country. They do, I don't know, like 5 billion or some stupid number every month. So they have literally 2,000 underwriters. 2,000, right? That's freaking nuts. So I'll submit a file for underwriting approval at 10 a.m. and I'll get an approval back by 1 p.m. the very same day. Okay, so it's a combination of those two things, that we submit very, very clean files, and the lender that we work with is very quick when it comes to reviewing files. When I was not a broker, when I was in retail, I remember I'd submit a file. It would take me a week, two weeks to get a commitment. It was crazy. It's absolutely nuts. And I think that's really, there are a bunch of other things that we do as well, Josh. Like, obviously, we order the appraisal the same day we get the contract. We're requesting title the same day we get the contract. We're doing all that stuff, but it's a combination of all those things, which is why we could close so quickly.
Got it. Thank you.
Then I have first of all, nice to meet you.
You too.
Great to meet you. What would these conditions be, and what can we do as agents to help make the process more efficient? What could we get from the client? That's one question. And then a second question on the side: what do you think of agents studying a lot about mortgage lending to really understand how the process goes, the financials and everything, to be more, more efficient on it as well?
So I'll answer that. Both great questions. I'll answer your second one first. So having a basic understanding is definitely because the client is going to always, like, the agent is always the glue of the transaction, right? They look to you for guidance. So for you guys to have knowledge in every area is beneficial. Now, are you going to master the mortgage business? No. I mean, I've been doing this for 10 years, work God knows how many hours, and I'm still learning stuff every day. So you're never going to get to a level of mastery, but having a basic understanding of how debt to income ratio works, documentation needed, stuff like that, that's going to be very, very useful. Now, to answer your first question, this is a funny one, because I'm told by a lot of agents that the lender asks you guys to help them chase conditions, which, quite frankly, you shouldn't be doing. Not because it's not your place, like, legally speaking. It's like, it's not your job. You're not getting paid to chase conditions and do our job for us. You have other things to do. You have business that, you need to prospect. You need to grab new business. So if you're working with a lender that is asking you to help them chase conditions, then that is a bad sign. So we have each client, when their loan is approved, they are assigned a processing team. On each processing team, they have one primary source of contact, and then there are two other processors on the file, just like to help out. If, for instance, that processor takes vacation for a week, another one can jump in and help them, right, and get the file and keep it moving, as opposed to delaying the file for a week. So there are cases, very, very few cases, where we will ask you guys as agents to help us out. Typically, that's when there's like a language barrier with the client, it's difficult to communicate, or they're not very tech savvy and they trust you. We'll ask you to jump in, but that's like 0.5% of the time, not even 1%. So bottom line is you guys shouldn't be chasing conditions, you should be asking for more business. Now, to answer your actual question, what those conditions are, the most common thing, because we get the approval so quickly, we get the approval before we even get the appraisal back. So one of the conditions will be, the appraisal. Another one will be for the client to bind their home insurance. Another one would be to obtain proof of the down payment, the EMD, coming out of their account, right? Small things like that, but those are the most common three. And then you've got things like an updated verification of employment. And at the end of the day, these aren't things that you can really get. It depends on the agent. Sometimes the agent wants to be informed the entire time and they want to help out with every single piece. Basically, we'll do whatever you want to do. It's up to you. It's your referral, it's your client, but we're fully equipped to handle everything from start to finish without you getting involved. Because again, it's not your job. It's our job. So that's what we get paid to do.
And I think, Ben, it is so important, right, to really partner up with the right lender, right? Because if you're working with the right person, you can depend on that guy to basically get everything done, right? Where you don't have to be chasing conditions for the people.
Yeah, it's not a good sign. Not a good sign at all.
So Ben, I have one question in terms of something little different in terms of qualification of the client, actually. The difference between how you guys compute the income for a W-2 versus self-employed.
This is a great question.
Combination, hey, I just throw a little curveball at you, right? I mean, it was the easy stuff so far. Combination of W-2 and self-employed together combined as well.
So this could go a million different ways. So, John, are you referring to someone who is self-employed but also gets a W-2 from their own business?
Yes, exactly.
Okay. So this is an interesting one, and it is a very, very common mistake that loan officers make. I have made this mistake in the past, and I learned the hard way, is that people, for those of you that have corps, right, self-employed people will W-2 themselves, right? I'm W-2ing myself literally right now. I got off the phone with ADP an hour ago, okay, because it's beneficial for tax purposes, and I have to do it by the end of the year. I've got 3 days left. Woohoo! So when someone looks at a W-2, they basically say, I can just give them this W-2 or this income from their pay stub as opposed to the tax return. So the way that it works, if it's self-employed income, even if it's W-2, because it's W-2, it gets put into the self-employed category and it is computed based on a self-employed income as opposed to a W-2 working for a different company. And let me know if I lost you because I can repeat that. It's a little complicated.
Yeah, one more time.
Yeah, okay. So let's say that Ben Lavender Incorporated, right? I W-2 myself, and I also give myself pay stubs, and I also file a corp and give myself a K-1, as many agents do as well. So from an underwriting perspective, the underwriter cannot use my pay stubs to calculate my income because I'm self-employed, and the W-2 is coming from my self-employed business. If the W-2 is coming from Tayeb Group, and I'm an employee of Tayeb Group, right, that's completely different because I do not own Tayeb Group, and they can pay me, or rather, underwriter can use the income based on my pay stubs alone. But because that W-2 is part of the self-employed business, it is subject to a self-employed income computation, which, depending on the program, is a 2-year average or a 1-year average, or just, well, recent 1 year. It's not really an average.
So what you're saying?
What is the 1 year versus 2 years average?
Yeah. So let's say that 2019 and 2020. You made in 2019 you made 100 grand. In 2020 you made 200. Underwriting will give you 150,000 for a 2-year average, right? Whereas if you just go by the 1 year, then the underwriter will only go off the most recent year, which is 200,000. With me so far?
And if the W-2 is from your self-employed, it would only count your own corp, right? Let's say you got the like you said, you pay yourself a W-2 for tax purposes, it would still be the income that you really have, right?
It would be
Not an extra.
calculated correct. So, but they would see that from the W-2. So you would get paid on that W-2. So let's say that you K1 yourself 150 grand, you W-2 yourself 50 grand. The underwriter will give you 200,000. Right? Obviously, there's more to it because you can add and deduct certain expenses and depreciation and blah blah blah. But that's the basics of it.
And why would someone choose to do a dual year if they could do well? It could be that the year before they had even more income. That could be a reason, right? Because if imagine I would like to get a loan for this year, and last year I was working at, I don't know, somewhere else. Do I have the decision to either pick to do an average of this year, or can I do it with both years?
That's another great question. So the guideline is that you can go off the most recent 1 year as long as that business has been active for 5 years or more.
Okay.
That's the catch.
That's a good one. And but and most loan officers probably they don't know that. They
They
always
have no
say
idea.
self-employed, it's average out over 2 years.
Yep. So we call that it's primarily used for Freddie Mac loans, which again, Freddie Mac is one of the two conventional. You have Fannie Mae and Freddie Mac. So it's primarily for Freddie Mac, but some Fannie Mae loans will allow it too. The only way to know is to run it through, again, the automated underwriting system, and the system will literally tell you can go off the most recent 1 year.
So in reality, if you didn't have a business for more than 5 years, you're going off the 2 years.
You got it. Exactly.
Okay.
And one more question with the W-2 and self-employed. If you work for your wife's family and you get W-2 from it, the owner, but your wife is, right? Now, is that going to be calculated as a W-2 or is it going to be looked at as self-employed?
It's a good question. It's a gray area because it depends on the discrepancy in the pay, right? It depends how long you've been there for, because they search everything, right? They'll search your last names, your business addresses, they'll cross-reference everything. So for instance, if you showed 1 year like 20 grand and the next year you show 200, they're going to be like, okay, it's John's wife's business. He's obviously just trying to qualify for the mortgage. But sometimes it's legitimate, sometimes it's not. And it's case by case, but best way to say it, if it's obvious, then they're not going to give it to you. And then they'll just think that you're trying to play something fugazi, as we like to say. But in many cases, it is allowable as long as it's reasonable and you're not trying to take advantage of the system. I've seen it been done before. They often want an explanation, how long you've been there for, what your position is. If the increase in pay is only like 5 to 20%, they'll allow it. Over 20% is typically, well, they'll freak out and probably say no.
Okay, thank you.
So basically, do not try to play the system.
Yeah, they'll find out. I mean, if you want to play the system, and I'm not going to say anything because this is a recorded call, but if you want to, call me and we'll talk about it. I can help with that, but not on a recorded. Not on a recorded call. And another thing that or self-employed people do, by the way, and this is perfectly legal, so I have no problem saying it, is that they'll show 20 grand net income for 1 year, and then the following year show 200 and qualify, and only use that 200 for the 1 year loan. Perfectly fine, perfectly legal. No, there's no rule against it as long as you qualify for the 1 year loan. So if you have self-employed people, which we all do, right? We all have self-employed people who are looking to qualify. It's something to discuss with them. So for instance, like my self-employed clients who don't qualify throughout the year, I always tell them, let's touch base in the first quarter of the following year. Send me a draft of your tax return before you file it. We'll plug everything into the system and tell you if it's enough to qualify for what you want to qualify for. And if not, we'll help them tweak it. And again, obviously nothing illegal. They always check with their CPA to make sure everything is, kosher in that regard. And we take it from there. That's one way to do it.
That's great.
Okay.
I have one more. With gifts, is there a limit to as much as you can get as a gift towards the transaction? and what it would be the right way to get that gift, and does that money has to be seasoned in the gifter's account as well?
Yeah, cash in a briefcase. Yeah, that doesn't work, right? So basically, there isn't a limit to the amount of gifts that you can get, as long as the purchase is for a primary residence. For investment purchases, gifts are not allowed whatsoever. Okay, that's a strict conventional guideline. Now,
For
when
primary
it,
residence?
I'm sorry,
For primary residence, you said?
primary residence, you can get as many gifts as you want. The
Yeah.
gifts can cover literally everything: the down payment, the closing costs. The buyer themselves doesn't have to bring anything. If their dad or mom or whoever wants to gift them everything, they can do that, no problem. The only thing that, like I said, for investment purchases, and when I say investment, I don't mean like a multifamily property that someone's going to live in and rent out the rest, because that's still a primary residence. Yeah, if it's a pure investment where they're not going to be living there, the loan application states it's an investment, I'm not going to be living there, then no gifts are permitted whatsoever. Now, when it comes to the sourcing, it all depends on the loan program. Sometimes this is more for conventional loans, is that you don't actually need to source it. They just want to see a wire confirmation of the money coming out, and you're good to go. Sometimes, like for instance with FHA, they want to see the money in that account for like 3-4 days, sometimes a month, right? It depends on the transaction. It depends when in the transaction. If it's for the down payment money versus the closing costs, it differs. But gifts are typically, because it's very easy, John, and I know what you're kind of getting at here, or at least maybe I think I do. Gifts is what we use to clean up funky transactions, right? So like I had one, which is actually, this is closing on Thursday. This guy, before he bought everything, we told him, you need to get a gift when you sign for the money for the transaction. You need to get a gift for the $30,000 that you're putting down on contract. Instead of getting a check from his mother's account, he went and deposited $30,000 cash into the bank, and then he wrote his down payment check the next day. So sometimes even when you tell them, they don't listen to you, right? It's really frustrating, but you could do everything in the world and they still won't listen. And how we got around it, I had to literally get on the phone with the seller and the seller's attorney and say, we need you to basically give the EMD back. I have to clean up the EMD, put it into another person's account, and then have that person gift it to him and then bring it to closing. It was a freaking nightmare, but we got it done.
Remember, Ellie?
I do, of course.
We had the same thing, right?
Yeah.
Yeah.
Was it FHA as well?
It was a beautiful, well, it is, right? It's closing Thursday. It's a beautiful, big old FHA loan. Now, how often do these issues happen? Not often, right? They tend to be more frequent with my clients that are immigrants, not because they're immigrants and they're dumb. I'm an immigrant myself. Half of us on this call are immigrants, right? It's really just because they're not used to the system here. Sometimes there's a language barrier. Sometimes they only hear what they only want to hear, whatever it is, but it tends to be the case with most of my immigrant clients.
That's awesome. Gosh, I know you had a question. I'm sorry I interrupted you.
No, it's okay. What is the max purchase price you can use on an FHA?
So it's actually not by purchase price. It goes by loan amount. So right now, of this very second, they're going to change, because typically what happens is in the beginning of the year, FHA changes to follow conventional. So conventional new loan amounts have been released, right? So again, it's not the price, Josh. It's literally the loan amount on the house, and I have a table right here. And this, again, this is specific to New York. It changes, actually, I should say, in the 5 boroughs in Westchester and Long Island and the higher priced areas, because it changes by county. Okay, so for a single family, it's $970,000, $800, right, is the maximum loan amount for FHA and conventional. If it's a 2-family, it goes to $1.243 million.
Wow.
Yeah, and $50. It's a weird amount. If it's a 3-family, it goes to 1.5 and change. If it's a 4, it goes up to 1.8 and change.
Wow,
What did you say?
On a 3-4 family, you could use FHA.
Yeah.
So after 4, it's an investment, right? 4 or less is you could still primary.
Yep, exactly. So
okay.
a lot of people like to house hack. They'll buy a 2 to a 4 live in it for a year, and then move
And then
out.
boom, move out.
And then, they replace their income with a new tenant. And not only will that income pay for the whole mortgage, but it will help them pay for another property that they buy for themselves. It's, in my opinion, if you're a first-time home buyer and you have an appetite for being a landlord, your first purchase should always be a multifamily. Always. Because if you then, for instance, use your FHA on a single family or even a two, right? Because a two is not that exciting. And then you buy it conventional, your minimum down payment goes from 3.5 to 20 to 25%. It's a massive, massive difference.
So
Unless
then,
you did well, unless you did well on
sorry.
the first one and cash flowing, and you just gotta stash the money somewhere, right?
Well, that's true, but I'm saying like if that person like bought a single or a two. But what you're saying is actually a really good point, John, because if they buy a 3 or a 4 and then they're netting anywhere from 3 to 6 grand a month, and in 5 years they save up 100 grand, boom, they can buy another 3 to 4 family as an investment in the legal manner. Or you could buy it as a primary conventional and house hack that way too, because if you buy a 3 or a 4 conventional, the down payment is about 5%. It depends on the program, but it's 5 to 10% less as it would have been if it was an investment. So that's like you can continuously house hack. It's legal as long as you live in there for a full year and you don't try and scam the system. No problem. You can keep buying multifamilies as
That's
primary residence.
primaries. Beautiful. Wow.
So you gotta buy one, live there for 12 months, right?
Yeah.
And then the next one can be FHA or primary.
Primary. Yeah.
Yeah. Well, you can't use the FHA again.
You can't. So the
You
FHA,
can't unless you refi out of it into conventional.
okay.
Yeah, that's the only, which honestly people should do anyway, because the mortgage insurance is very high on FHA loans. So
Yeah.
we want to obviously refi people out of that ASAP because it's going to save them, $400 to $800 a month.
Yeah.
So the more the PMI on
Quick
FHA,
question. 5 minutes. Is it residential or commercial?
Commercial. That's commercial. Ellie, sorry, you had a question. Is it Ellie or Eli?
it can be both. However
What do you
wish.
prefer?
Ellie, call me Ellie.
Ellie, it is. Go
So,
ahead, brother.
so for example, if you have what was the total loan amount for two family? Was it 1.23?
1,243 and $50. Weird number.
1,243. So if you were to add the 3.5%, does that average? So that you also have a maximum price point, 1.25, I think it is, or 1.24, or something like that.
Well, it's not the price, it's the loan amount. So let's say that you find a two family for 1.8 million, then you could take an FHA loan on it, but you got to put a down payment down so it goes down to the 1.243 number.
So why would you take an FHA loan if you're still putting more down payment and you have more mortgage insurance?
It's a good question, because sometimes people will have the money, but they won't have enough to meet the conventional guidelines. So the minimum down payment conventional two-family primary residence is 15% down, 1.5.
Okay.
Right. So sometimes people will only have 12%, and they can't make it, so they'll just make it with FHA, and then they'll go that route, and then again they'll refi out into conventional in a year or two when they have enough equity.
So you can do FHA 3.5 until 14%. It can still be an FHA loan. I'm
Yeah.
putting 14% down, but I'm doing FHA loan for some
No,
reason.
you could do 50%. You could do 90%. The crazy thing though is no matter how much money you put down on FHA, there's mortgage insurance on it.
So everything under 15% is FHA?
No. So for single family, so the 15% is the minimum for two family primary residence. If it's a single family and you're a first time home buyer, you can do 3%. If you're not a first time home buyer, then it's 5%.
And how long it takes to be a first time buyer? Is it just once in a lifetime, or is it like
you cannot have owned or purchased a primary residence within 3 years.
Okay. So if you're 3 years without buying a home, you can do an FHA.
You could do FHA, or you could do conventional, 3% down.
And why would you can do conventional 3% down as well as FHA?
On single family, darling.
Yeah.
Okay.
Only on single.
Multi-no. Okay.
What about secondary, Brian? Ben.
10% down conventional.
Okay.
I got a question. How do you calculate PMI? So I have a thing. I run the numbers, but how do I calculate how much PMI is?
So for FHA, it's a fixed number. And there's a table that I could send you. So the standard FHA MI factor, and that's the percentage, by the way, that it's calculated. If the loan amount is under 625 and you're putting less than 5% down, then it's calculated on a mortgage insurance factor of 0.85%. If you put down 5% or more, it goes down to 0.8%. Not a huge difference, right? We're going from 0.85 to 0.8.
Yeah.
Now, if the loan amount is above 625, then the FHA MI factor is 1.05 if it's under a 5% down payment.
Mhm.
And if it's more than 5%, then it's 1% flat. So you can see that if you're using FHA on a very large loan over 625, your mortgage insurance is juicy.
Yeah.
Like I do a lot of FHA loans for people buying 3 families in the Bronx for anywhere from like 600,000 to $1 million. Their mortgage insurance is massive. It's absolutely massive, but they're okay with it because they get enough rent to cover it. And the truth is we refi them out of it into conventional within a year to 3 years where they've built enough equity, because this market, people have been gaining 10% equity every month. It's freaking nuts, right? So people can refi and eradicate the mortgage insurance very quickly. So even though they're paying $800 a month in mortgage insurance, it's very short term.
With the PMI ban, I know years ago, after 10 years, automatically drops off, right? Now, when you reach 20% of equity, it drops off automatically, or do you have to refi? Or there's a difference between FHA and conventional to that case?
Yep, hold that thought, because that's going to take me a few minutes to explain. But one thing I wanted to finish with, Josh, that question, I only answered for FHA. For conventional, it's very different because there are numerous factors that affect the PMI. One is there are 2 main ones. One is the down payment amount. The more money you put down, the lower the mortgage insurance is,
Mhm.
and the credit score. The credit score, the higher the credit score, the lower the mortgage insurance is. Now, depending on the bank that you go to, they'll hit you for other factors like your debt to income ratio and how many people are on the loan. Okay,
Wow.
that will affect the mortgage insurance as well. And keep in mind, mortgage insurance is private. It's done by individual companies. So United Wholesale Mortgage, who I send most of my loans to, because they do a gajillion loans a month, they actually have the lowest private mortgage insurance in the entire country. So I never lose on mortgage insurance because they're always the cheapest, but it will be different from one company to another. It also depends on, like I said, the loan amount, the type of property, how many units, credit score, blah, 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 blah. Now, Josh, back to, what was your question? How to calculate? It wasn't how to calculate, it's how long it was on it for, right?
No, it was how to calculate it. So
I'm sorry, but John's question was how to...
How long it stays on with the loan, and how to get rid of the difference between FHA and conventional.
So I'll answer FHA
No worries,
first.
and people always confuse me and Josh too. So
Yeah, sorry.
I'm the
You,
better
you
looking
look, you
one.
guys look similar.
Yeah, you look the same. Good-looking guys. We got a bunch of good-looking guys in here. The ladies are missing out. They should have been on this call.
Should have,
They're
right?
lost. They're lost. Don't worry about them. Okay,
Next
so
time we'll market. Next time we'll market towards them.
yeah, Magic Mike Mortgage Special.
Yeah.
So FHA is easier because basically if you put less than 10% down on an FHA loan, the mortgage insurance stays on for the life of the loan. Forever. Crazy, right? So they instituted that rule about 6 years ago. I think it was in 2014. It was a couple years after I got into the business. Before that, it used to cancel at like 20% down. Now, if you put down 10% or more on FHA, it automatically cancels on the 11th year. It just drops off entirely.
If you said 11% or more,
10% down or more, it comes off on the 11th year. Now, one thing that's kind of cool about the FHA mortgage insurance is that it does decrease every year. It goes down because the mortgage insurance is based on your loan amount, right? So as your loan amount decreases, so does the mortgage insurance. So depending on your loan amount, it will go down anywhere from $1 to like $20 a year, and then it just gets higher and higher and higher anyway. For conventional, it depends on how much you're putting down. If you're putting down 15%, it will typically come off within 5 years, right, to get to that 22% equity mark. So a common misconception is that it automatically comes off when you hit 20% equity. That is incorrect. It automatically comes off when you hit 22% equity. Why? I don't know. That's the way these mortgage insurance companies just do it. And that's the way they've been doing it for about 5 years now. Before it was 20%, but they changed it.
That's what I thought. Yeah, I thought it was 20.
Yeah. Now, if you think that you have reached 20% equity, they can take it off at 20%, but you have to call the mortgage servicer and you have to get an independent appraisal done. And then if the value is there where you have 20% equity, they'll potentially remove the mortgage insurance. You could do that.
So they automatically take it off. It's not you have to refinance.
You don't have to refi. Yeah, you don't have to. But they'll automatically take it off when you hit 22% equity. But you can accelerate that by paying down your principal, right, to get closer to there. Or you can again order an appraisal to show that your appreciation has grown to get them to remove it. But they have to agree to do it. It's kind of a pain in the ass, but it's worth it to save the money.
Yeah.
Now, quick question, since Josh said the refi, right? How can you save on the closing cost on the refi?
How can you say, okay, so the number one method, and this is more specific to New York, is something that we call a CEMA. I believe it stands for Consolidated Extension Mortgage Agreement. I think that's what it stands for. What it basically means is that you don't have to pay mortgage tax again. So in the 5 boroughs, the mortgage tax is freaking massive. It's anywhere from 1.8% to 2.2% or even 2.3% of the loan amount, right?
In the closing cost, right? We pay this.
Yeah, that's just part of the closing cost. Okay. Exactly. So if you're, for instance, buying a multifamily in Queens for $800,000, your New York State or Queens County mortgage tax alone is going to be roughly $19,000. Freaking massive. So when you refi, you can avoid that by doing what's called the CEMA, which is basically where we contact the loan servicer and file the CEMA paperwork so the borrower or the buyer does not have to pay mortgage tax again. Other than that, the closing costs are more or less the same as it is on a purchase, with the exception of like some title fees are a little bit cheaper, maybe like a 1/3 reduction in title, but overall, everything else is more or less the same as a purchase.
So you can just transfer the title insurance, where they can sort of like a recap.
Precisely. Yeah, I know what you're getting at. So you don't have to pay for certain aspects of the title insurance again because nothing has changed, but you still have to get a new title. They have to order a new abstract and all that. So that's part of it, but it's definitely cheaper on a refi.
All right. Any questions, guys?
I got one more.
Yeah.
All right. So what would you say so let's just say we have a deal going, right? We submitted an offer. What would you say to the listing agent to get the deal done about the buyer?
Anything. I have to. I won't disclose anything too personal, but I basically walk them through. Okay, actually, let me take a step back. So if you guys, for instance, copy us on the offer to the listing agent, what I tend to do is reply with a video, right? Because I have my camera right here. I'm at my desk. So I just say, hey, this offer was just, as you can see, submitted through Josh at Tayeb. We have every single document on the planet, as I mentioned before, tax returns, W-2s. The debt to income ratio is X. They have this amount of money. They've been working at this job for 15 years. Everything is solid. Our average CTC timeframe is 17.9 days. We're very quick. We can give you references. It's basically a rock solid deal. And that's typically what does the job 9 times out of 10. But, we're careful because we don't want to divulge too much information, but we also want to give them confidence. And I'd like to think that's something we do a very good job of.
Okay. Thank you.
It looks like Josh is interviewing you, man, almost.
I'm ready. Always ready.
I got another one. I think we probably see this, more often, especially lately, since COVID hit. It's assistance with a down payment and closing cost. How often do you see those, and what would be some of the resources for people to look up?
Zero. I don't have a good source, unfortunately, for grants or anything like that. The programs, I know they exist. They definitely exist, and some are more reliable than others. One of the reasons why I personally just don't mess with them is because they're unreliable. Like for instance, the buyer will go into this course where every Wednesday at 8 o'clock they have to show up and they'll get like a $5,000 credit and they take this class. And then when it comes time to getting the money, they have to redo all the paperwork, or all of a sudden they don't qualify. Or if they do qualify, it takes them 6 months to get the money, and then the deal dies entirely because it takes 6 months. So that's the reason why. And again, in the 10 years that I've been doing this, January will be 10 years for me. I have not done one transaction with a grant on it because of those reasons. I know loan officers that have, and it's typically an absolute nightmare. But if you can pull it off and you can pull it off well, I'd love to learn about it because it could help a lot of people. But it's I haven't come across a reliable source. And this, by the way, is specific to New York. First-time homebuyer programs out of New York State tend to be extremely reliable and easy to work with. But in New York, they tend to be, for lack of a better term, shit.
Yeah.
That's a good term.
Yeah.
Do you think this is because of the bureaucracy or some sort of connection with public institutions that it's like that?
Probably. I think that's the only logical explanation, right? Because they're typically government programs. As we know, the government tends to be a little bit slow with these things, especially because they're nonprofits and the employees that work there aren't getting paid very well, so they tend to not care. Like a good example is like a program that has been good historically is Sony May. We don't do Sony May loans, but Sony May has been known to be quite good. They tend not to take 6 months. Maybe they'll take 3 or 4 months, which in New York you can kind of get away with. But that's a good program. However, I spoke to a realtor actually who sits on the board for Sony May, and he told me this might have changed, but he told me this about a year ago. He stopped sending Sony May loans because of COVID messed them up, and everything's taking them forever. That might have changed now because, again, he told me that a year ago. But these things change from time to time, so that's something that we have to watch as well. But for instance, I know what I'm good at. My bread and butter is conventional FHA and VA loans. I don't do renovation loans. I used to do them. They're a whole other. If you can avoid doing them, I recommend you avoid doing it. If you don't have a choice, fine. But it's not ideal. It's a lot of work, and the buyer tends to have a very, very difficult experience because there's so much freaking paperwork, and you're dealing with contractors who have to submit paperwork. Not to knock on contractors, but they're not known for their paperwork skills, right? So that tends to mess things up a little bit. But again, there are anomalies. There are these renovation transactions which can go very smoothly. You just need all the stars to align. So, all these like funky exotic products are kind of case by case. And if you are working on a loan which is a renovation loan, make sure that loan officer is a freaking expert, that he's done or she's done 1,000 of them before and they know what they're doing, because if not, it could be a nightmare.
And one more question I have, but I know it's 3 o'clock and we all gotta go.
Yeah, I got time.
Working with
It's a slow week.
realtors,
Everyone's chilling. Sorry, John.
what it's one of the, I would say, qualities or help the realtors can really assist you with getting the loan done in a way. And I know you said, hey, it's not their job. I get it. But what are some of the helpful things you see some of the realtors do, which is helping you and the client really close the transaction?
So simple things like making sure we get the contract is a very, very simple one. This was summer of last year. I was doing a deal in upstate New York. The buyer signed the contract. No one sent me the contract. I'm not exaggerating, for 7 weeks. For 7 weeks.
Only 7? That's pretty good.
Yeah, 7 weeks. And I wish I was exaggerating. And the funny thing is that we spoke to the buyer several times throughout those 7 weeks. And we were like, how's everything going? He's like, good, we should be in contract soon. he didn't realize he signed a contract. He didn't know, right? But the realtor knew, and the realtor could have sent us the contract. So anyway, simple things like that, sending us the contract, just staying in close communication. We try and be proactive. So I put this into play about a month ago. I have a full-time transaction coordinator that updates you on certain milestones in the process. Those milestones are when the appraisal is ordered, when the appraisal is scheduled, when we get the appraisal back, what are the results, when the loan gets approved, when the loan gets clear to close, and when the closing is scheduled for. And we send you a calendar invite with where the closing is and the time, because we want to make life a little bit easier for you and give you a little bit more value. And we find that that helps. So we've been doing that for a month. The feedback's been really good. But other than that, I would say, actually, John, I'm going to answer your question with something that realtors should not do. Okay. So as we know, buying a home is not how it looks like on HGTV, where we're skipping through the meadows with, with Bambi and a squirrel on our shoulder and dancing, right? It's stressful, especially for the buyer. You think it's stressful for us, it's 50 times more stressful for them. So real estate really is subject to Murphy's Law. If something can potentially go wrong, it always will. There's always some type of issue on a transaction. I would say not 9 times out of 10, but there's always some type of speed bump, whether the seller, needs a little bit more time to close. There's a title issue. The appraisal is taking a few more days than expected to get in touch, whatever the case may be, right? So my recommendation is to not mirror your client's anxiety. Okay, so if they're like, oh, this title issue, I'm freaking out, responding and saying, I know it's crazy, this is so unprofessional. The thing to do is to respond in a calm manner and say, hey, I know it's frustrating. Unfortunately, some things happen that are beyond our control. I'm going to investigate, see what I can do to speed this along, but there's no sense getting worked up about something that we cannot control. So the thing to do is basically not to create drama. I also find this, and this is going to sound messed up of me to say, but I'm going to say it. It's a very, very common trait in low producing realtors, right? Loan officers too, quite frankly. I shouldn't just rip on realtors, right? Is that they create drama because it makes them feel important. It feeds their ego, right? It's like, oh, there's this issue. I'm going to make it an issue and I'm going to be the one to solve it so I can look like a hero. That's what a lot of low producers do. And all it does is frustrate everyone involved, the attorneys, the bank, and most importantly, you're giving your client a poor experience by inflaming their anxiety and not reducing it. So that's my advice, is to, keep calm and just keep the boat on the correct trajectory so everyone has a good experience.
That's great. That's great.
Amen.
Cool,
Nice.
calm, collected.
Yep. Slow down your tone. If they're going, blah, 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 relax. It's okay. We'll survive.
Exactly.
Drink some, smoke some, just be happy and focus on the next deal, right?
That too. I offer them ganja. Sometimes they say yes, sometimes they say no.
Nice.
Legal.
So Ben, we're actually going to be starting a podcast sometime.
Cool. Congrats, guys.
So you're invited.
Thank you. I'd love to be on. Appreciate it. And I'm going to have all you guys on too. Right. We had John. John, again, that was by far my favorite one so far. Again, I'm not just saying that. That was really, really special. We're going to continue to drop some more, obviously, tidbits, but I'd absolutely love to be on yours and drop some mortgage bombs, so to speak.
I watched half of it. I didn't get to finish the whole thing. You posted it 2 days ago, right?
I think so.
Yeah.
Yeah, I didn't post it. The Madison marketing guy does.
Yeah.
Job.
It's good.
Yeah. I got. By the way, do you guys, John? I know that you got one. Do you guys have BNB swag? I got to send you some.
No.
Okay, I'll have my assistant call you, get your sizes and stuff, and she'll mail it to you. It's honestly, and again, I'm not just saying this, is that this is so freaking comfortable. I wear it for 2 places, either the gym or around the house just to laze around, because it's super, super comfy. So we'll get you guys some swag.
It looks good. Sounds good.
Man.